In this masterclass today, I am going to try as much as possible to simplify the topic on market structure. Okay? You see, 90% of all traders who attempt to trade in the financial markets are likely to consistently lose money in the market because they do not understand the simple topic on market structure. You see, to summarize this topic, we need to look at three things. Okay? When we study market structure, is divided into one, we need to look at basic market structure. We'll be looking at advanced market structure. And lastly, we'll be looking at the multi-dimensional market structure. Okay? Multi-dimensional market structure. Okay? So first we start with the basic market structure, where we form higher highs and higher lows when you are looking at an uptrend, or lower lows and lower highs in a downtrend. We are going to look at the advanced market structure, whereby we will be discussing about the internal market structure in a high and in a low. Okay, and lastly, we'll be looking at the multi-dimensional market structure. Okay, just to start, let us look first at the basic market structure. The basic market structure, we'll first look at an illustration that is in an uptrend. Okay, let us say that you are buying low. Okay, so our low is here. Okay, and we are buying low. Okay, the market will tend to rise in a bullish with some bullish momentum. Okay, forming what? A higher high. Okay, normally the market moves with swings. Okay, so it is expected to retrace, okay, a bit, and on these retracements in a bullish market, we do not expect the price to come and break this low, so it will form something we call an HL. A HL is a higher low. Okay, this higher low is what we refer to us as our swing low. Okay, good. So remember, we are in an uptrend and the market has some bullish momentum. So what is expected is that the price will start gaining momentum again. Okay, when the market breaks through these points, which we call a BOS. BOS meaning is break of structure. Okay, it forms another higher high. Okay, it forms another higher high. The buyers in this case will detect that the market is overpriced. So the next thing they'll do, they'll start taking their profits, and the market will drop up to our previous break of structure. Okay, it will form another higher low. Okay, the market will tend, the buyers will see that the market is in a bargain price. It is a low and it is a cheaper price. So with some good bullish momentum, we expect the buyers to take the market higher and higher and higher, breaking this second higher high, forming a what? A BOS, a break of structure. Okay, when the price reaches here, the third higher high, again the buyers will sense that the market has gained some good momentum and the price is overpriced. Okay, so what tends to happen is that these buyers will again start taking profits. Okay, in this case scenario, so the buyers will start buying again, forming another break of structure at around this place. Okay, forming a what? forming a higher high, forming another higher high. Okay, the price tends to come and correct itself because we said that the market is either efficient or inefficient. Okay, so the market will tend to come to this previous break of structure, and then it will tend to go form another break of structure to form a higher high. Okay, most of the cases, if the trend has come to an exhaustion, this will mean that it will not break that higher high. Instead, it will trade like that, come to that previous point and maybe go up, okay, and maybe come down. Okay, so the market will come causing a break of structure here, and in this case this one was our higher low. Okay, here it was our higher low. Okay, instead of forming some higher highs up here, we see that there is a break of structure here. Okay, there is a break of structure here, and what is happening here is called consolidation. Okay, good. So there was accumulation here, some consolidation here, and we are about to experience some distribution. Okay, so if there is exhaustion of this uptrend, you'll see that this place was our previous support. Okay, but in this case, if the trend is to change from an uptrend to a downtrend, the price will come retest this level. Okay, come down. We see we had a higher low here. Okay, right now this is our lower high. Okay, compared with this is our lower high. In this case, this becomes our first lower low. Okay, the price comes, causes a BOS here, causes a BOS there. The price will come, retest that zone, continue going down, forming another BOS here, come retest this zone and continue on a down trend. Okay, good. So you see, basic market structure simply tells us the direction that the price is likely to trade on based on these external swing points. Based on these external swing points, in an uptrend, these external swing points are referred to us as higher highs and higher lows. So in a trend, when you see higher highs and higher lows, you know that that is an uptrend. Okay, good. So the direction we are going is that. Okay, here we are having some consolidation. Okay, good. So the swing points in this case that we are having a downtrend, we are having some lower highs and lower lows, some lower highs and lower lows, lower highs, lower lows, lower highs, and some lower lows. So in this case, we are experiencing a what? A downtrend. We are experiencing a downtrend because we are having some lower highs and lower lows, some lower lows and some lower highs, some lower highs. Okay, so based on these external swing points, you are able to see the direction that the market is coming from or where the market is going. Okay, so if you look at any market, you will always be able to identify areas where price will experience sharp market reversals, like from this place to this place. Here, some buyers have started taking profits and the market will drop again before the same buyers or more buyers enter that trade, increasing some bullish momentum into the direction of the trend and causing this break of structure and this break of structure and this break of structure, so that the price will continue to trend higher and higher and higher. Okay, Good. So these areas that produce these reversals are what we refer to as swing points, the way I have labeled them. Okay. So by mapping out our swing points, we have a very good idea of the direction of price. Okay. So simply put, that half of the battle in trading is understanding which direction to trade in. Okay. So first, we see the most important thing to note is direction. Okay, which direction or the trend to trade in. Okay, secondly, remember that profitable trading is in which direction to trade in and where to trade in that direction. Okay, so the second question that we answer is where. So where do we enter and where do we exit? Okay, so when you answer the first major question on the direction, you answer the second question. Basically, your percentage win is around 50%. Okay, and with 50% as your risk to reward ratio, and you are trading with an RRR, risk to reward ratio, of around 1 to 3, you are in a position to make some good profits in the financial market. Okay, so if you get these two things right, then you've just got it. Okay, and that is exactly what we are learning in this masterclass. Okay, so first things first, we have this external swing points in the market, as you can see. Okay, so this right here is the current highs. Okay, and this here is our current lows in this market. Okay, so price, we've said, comes down, fails to break this low. Okay, it fails to break this low. All right, good. So then the price will start trading higher and higher, causing a break of structure. Okay, and it goes above this high. Okay, we've said that when you see price falling from a higher high, it means that there are some buyers who have seen that the market is too expensive and they've started taking some profits. Okay, now essentially what happens after a break of structure, okay, is that the price finds an agreed upon price. Okay, so this price is an agreement between buyers and sellers. Okay, if the sellers will become more stronger than the buyers, the price will start to fall. Okay, good. So now these laws are consequently going to be called swing lows as we go up and up and up. Okay, so when we reach at the top here, this swing low is what is currently controlling the price. Okay, and until there is a break of this swing low, as you can see, the BOS that we were saying here, we now confirm that the price, after breaking the break of structure here, it is now going in a downtrend. Okay, so the downtrend will start from there. But if there is no breakage of this current swing low, the price will continue going in an uptrend. Okay, good. So then we have the high, we have this high that was produced with this swing low. Okay, now we have expectations here because you look at the first swing low, the second swing low, so we have an expectation that the price will come and trade above this higher high. Okay, and it does, you see. Now after some point in time, the price will experience an exhaustion around this place. Okay, so the trend is becoming weaker and weaker and weaker. Okay, so you will see a final move in the consolidation here. Okay, and then there is something that is likely to happen. What is likely to happen at around here is something we call CHO. That is change of character. Okay, So this BOS can also be called a change of character. So what is a change of character? A change of character is simply a shift from the bullish market structure to a bearish market structure, or from a bullish price action to a bearish price action. Okay, so this simply describes the basic market structure. If you are able to correctly identify the swing highs and the swing lows, the swing highs and the swing lows, the swing highs and the swing lows, you are in a position to correctly identify whether the market is in an uptrend or the market is in a downtrend. Okay, and remember, we just said that you will get this if you understand that just two things. First is the direction. Second is the question of where. Where should I enter and where should I exit? For example, if you were buying, entering long positions, this would be the best place for you to do what? To enter into these trades. Okay, because you are entering into a low and a low. Okay, and consequently you will be looking to TP around these highs. Okay, you'll be looking to TP to take your profit at around those highs. Once you get this change of character, now the expectation has shifted. Okay, now you are looking at bearish moves. The formation of low highs and lower lows confirm that you are in a downtrend and there is some bearish momentum. Okay, good. So you see, it seems very easy if you look it in a whiteboard. Okay, but the reality in the market is that it doesn't run on just basic market structure. Okay, market movements are quite technical. Okay, that is why we are going next to look at the advanced market structure to further understand in a more advanced outlook how the price moves. Okay, I'm going to wrap what we have just discussed on the basic structure and look at how the advanced market structure is. So just know that the combination of basic market structure knowledge, the advanced market structure knowledge, and the multi-dimensional structure knowledge is going to help you to trade profitably. Okay. So here we are going to look at the advanced market structure. Okay. We are in an uptrend. Okay, I like using some bullish illustration. Okay, we are in a bullish state, and we say that we have our low here. We are buying low and selling high. Okay, the market makes some good bullish movements. Okay, we form our first higher high. Okay, the markets, these buyers will they will see that the market is very expensive, and they will start taking some profits. Okay, they will take profits until some of the buyers are convinced that the market is it is in a bargain. Okay, it is, and you'll experience that there are some buyers who have seen some this bearish move, but remember that the price is not able to break down below these lows. Okay, you get some other buyers, they come in, they push the market higher, they cause a break of structure. Okay, they cause a break of structure. After causing this break of structure, they move to more higher highs. Okay, they move to more higher highs. So we form a higher low here, and this one is our swing low. Okay, on the formation of this higher high, this is where we are going to look at the advanced market structure. Basically, advanced market structure refers to the internal market structure of a basic market structure. Okay, you'll find in an instant that the market will start forming some higher lows, okay, and some higher highs. Some some advanced markets higher lows and higher highs, higher lows and higher highs, higher lows and higher highs, higher lows and higher highs. Okay. For some reason, the market does not come and break this swing low. Okay. What does the market come and do? The market stretches a bit with some bullish momentum. Okay, breaking this causing a break of structure here on this higher low. Okay, it causes a higher high here. Okay, the market pushes down, again pushes up, pushes down, pushes down, pushes up, pushes down. The market goes, breaks this with causing a break of structure here. Okay, the market again comes down, retest that zone, come here, breaks this zone. So what you are currently seeing here is from here to here is what we call basic market structure. Okay, and from here to here is what we call advanced market structure. So advanced market structure is what happens in the basic market structure. Okay, remember we had formed these higher highs. Okay, but the market has not yet broken, so this one is our swing high, our swing high. So why are we looking at the advanced market structure? We are basically looking at the advanced market structure ideally because we do not want sorry, to take some bearish position on an internal market structure. Okay, we see that this low and this high are the current points who have the direction of the markets. Okay, once you break the swing high, we are in a confirmed, you can start taking some bullish trades. And once you break this swing low, you are waiting for the confirmation to take some bearish positions. Okay, so in that context, here there was a formation of some higher low, here, some higher high here, some lower high. Okay, this is a higher low, this is a lower high here. This one becomes now a lower low. In this internal market structure, this becomes a lower low because it has broken the lower high. This one becomes a lower high, this one becomes a lower low, a lower high, a lower low, a lower high. This one is the lower low. This one becomes now a higher high because we have broken a lower high. Okay, this one becomes a higher low, a higher low. This is a lower high. This one becomes a higher low. Okay, this one becomes a lower high compared with this. This one becomes a lower low because it has broken what? It has broken a higher low. Okay, this one becomes a higher low, higher low, a lower high. Yeah, this one is a lower high compared to this, and this one becomes another lower high, and this one is a higher high. This one is a lower high, this one becomes a lower high, and this one becomes a lower low, like that. Okay, so these lower highs and higher lows, you may hear it as a song, you may feel like they are confusing you, and that is why we are saying it is the advanced market structure. Okay, so you see here you can clearly see if we were to take some buys, you can buy from here. Okay, but in this advanced market structure, it is not really clear where you should buy or where you should sell. You see, the bigger picture, according to the basic market structure, is that here we are in an uptrend. Okay, but see, according to this market structure here, we are in a downtrend within an uptrend. Okay, this one is a downtrend within an uptrend. Okay, so in any case, who are in control of this market? We are saying that the buyers, the bulls, are in control of this market. But here we are experiencing some low highs and lower lows, low highs and lower lows, low highs and lower lows, confirming a minor downtrend. You see, someone on the 1 minute time frame can be trading sells, thinking that the market is downtrend, but when you look it at the 1 hour time frame or the 4 hour time frame, you will confirm that the market is bullish. Okay, good. So you'll find some traders are selling here, some are selling here, some are selling here, some are selling here. Okay, and you'll see some of those who are thinking that the market is bullish will be taking some bullish positions from here, bullish positions from here, bullish positions, and some bullish positions. Okay, so you see, this is why we're saying that the market is in an advanced market structure. But our biasness in the market, remember, we are still bullish. Why? Because we have not yet broken our main swing lows and we have not broken our main swing high. Okay, so there we have internal market structure. Okay, so ideally we do not trade the internal market structures because these are our swings. Okay, the market is just swinging. Preferably, most of the time you'll find the advanced market structure where we have internal market structure, the market is in consolidation. Okay, so we do not trade consolidation, we trade breakouts. We wait for the markets in the accumulation and the distribution phase. Okay, mainly when we are trading the AMD concepts or the smart money concepts. The AMD concept is the accumulation, manipulation, and distribution. You'll find here is where most manipulation takes place. Most manipulation takes place here. Manipulation. Okay? Most manipulation takes here because you find traders trading on the internal market structure rather than waiting for the external market structure. Okay, so whoever sold here, whoever sold here, whoever sold here and here, those that traded sells here and here, they were taken out by this swing high. Okay, and those that traded sells from these positions were taken out by this swing high. So whoever sold here, they've been taken out by that trade. Okay, and those that bought here, they were taken out by these sellers. Those that bought here were taken out by these sellers. Okay, and those that bought here were taken out by these sellers. Okay, so you'll see a lot of money is being lost here on the internal market structure, and that is why we look at the large time frames to get our biasness. Okay, the market stretches up, causing a break of structure according to this swing high, forming a higher high, comes down, forms a lower high comes here, forms a higher low, a lower high, comes again, retests the internal market structure, forms a lower low before the market goes up on the original trend, which was a what? Which was an uptrend. Okay, good. So you see, the market moves in a more complex structural pattern. Okay, that is why it is labeled advanced. Okay, but the reality is that the principle remains the same. The principle that operates the basic market structure and those that operate the advanced market structure are ideally the same. Okay, we have just said that the advanced market structure describes the internal structure between the swing high and the swing low. All right. So to understand the difference between the basic market structure and the advanced market structure, you have to know your swing highs and your swing lows. Okay. Good. But just note that understanding the advanced market structure will help you to differentiate between internal swing points, okay, and external swing points, okay. So this one are the external. This one are the external swing points. This one is the external swing points, while these ones are the internal swing points of the market. Okay, just simply by looking at this, we are done with the internal market structure. Okay, but again, if you want to understand this clearly, you must also put into consideration the multi-dimensional market structure. Okay, so if we are done with this, I'm going to rub and illustrate the multi-dimensional market structure. So what is the multi-dimensional market structure? From the word, you hear the multi, meaning multiple, multiple more than one, the multiple dimension market structure. Okay, the multi dimensional market structure. So what is the market dimensional structure? You see, on the multi-dimensional structure, the market comes from a low, forms a higher high. Okay, there is formation of a lower high, a lower high that does not break below this low. Okay, the market gains some bullish momentum, goes up, breaking this higher high, and forms what? Forms a BOS, a break of structure. Okay, good. So after the formation of a break of structure, the market tends to come back, corrects this inefficiency. Okay, comes like that, like that, like that. Okay, let's say that our market price action is like that. Okay, our blue lines would characterize price action on a higher time frame. Let us say that the blue, it characterized something like the 15 minutes time frame. Okay, good. So to really understand the multidimensional market structure, let us look at a different time frame. For example, let us look at 1 minute. Okay, so 1 minute time frame, on or from this distance from here to here, the market does not move linear. Okay, it forms higher highs and higher lows on an uptrend. Okay, let us say it has come from this low, so the market will move like that, forming a higher high, higher low, higher high, higher low, high, higher low, higher high, higher low, higher high, higher low, high, higher low. Okay, like that. Okay, here it will form lower highs and lower lows. Okay, it changes shapes and forms higher highs and higher lows. Okay, so this is what really the market looks like in a multiple dimension market structure. Okay, so the red line here signifies 1 minute. Okay, good. So to really understand this, we are saying that the multiple dimension market structure, it really gives you a deeper understanding on how to identify the main swing highs and the main swing lows. Okay, good. So you see, one of the biggest mistakes that many traders make while trying to trade the market structure is that they forget that the market structure is multi-dimensional and it is not in a singular dimension. Okay, so what that means is that if you look at any time frame, let's say 4 hour, 1 hour, 15 minutes, or the 1 minute, you will see something different each time. Okay, because you see, one time frame is simply a just singular view of the same price action. Okay, you see, one trader may say that the market is bearish right now. Okay, and another one may say that the market is bullish, okay? And either one of them is right. Whoever said that the market is bullish here, looking at this swing highs and swing lows on the 1 minute time frame, is right to say that the market is bullish here. And whoever said that the market is bearish here, according to these lower highs and lower lows, is also right. Okay, so the difference is that you are looking either at a large time frame or a smaller time frame. Okay, you see the market can either can be bullish on the 4 hour, and it can be bearish on the 15 minutes, okay, depending on the time frame that you are using. But remember, we want to use multiple time frame analysis. Okay, we want to see that we are having some bullish market structure on the 4 hour, which 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 is the same as the bullish price action on the 30 minutes and the bullish price action on the maybe 5 minutes. Okay, if you're using 4 hour, 30 minutes, and 5 minutes. If you're using 1 hour, 15 minutes, and made of either 1 minute, you will want to see bullish price action on all of those time frames so that it confirms to you that you are on the right trade. Okay, so the markets, you may experience that both of you, if you are having two traders, you'll have the same market, same currency pair. For example, you're trading Euro USD. But if you are trading different time frames, all of you may have different perspective on the same market. This can be seen that the market is bullish, and you can be seeing the market to be bearish. Okay? You see, the market is just one existing, living, breathing organism. And a time frame is just a singular perspective of the market. Okay, so the multiple dimensional market structure is looking at various time frames. For example, the 4 hour, 1 hour, and maybe the 15 minutes time frame. Instead of just looking at either the 15 minutes time frame or the 1 minute time frame, if you just do that, you will get a better understanding of the multiple dimension market structure. Okay, so you see within this 15 minutes time frame, if you're looking at the market on the 1 minute time frame, you are likely to see that the market forms additional internal market structures. Okay, if you got the 5 minutes time frame, you'll see something completely different. But when you come from top down analysis, let's say from the daily time frame down to the 4 hour time frame, to the 1 hour time frame, the 15 minutes time frame, and to even to the 1 minute time frame, if you find some confluence on all those time frames, remember when we were looking at the top down analysis, the multiple time frame analysis, we said that you should start with 2 time frames. Okay, but if you feel confident, you can even go to 3. So if you're looking at the daily, you want to go to the 4 hour and then to the 1 hour. If you're looking to the 1 hour as your large time frame for analysis, we want you to go down to the 15 minutes and possibly even to the 5 minutes or the 1 minute. Okay, so we have just come to the end of our market structure class today. If you're watching this on YouTube, I would kindly ask you to subscribe, like, and share this video with your fellow traders so that anytime we produce such a masterclass, you will get notified by YouTube. I hope you have gained considerable value in this class and you have learned something new.